said that AI is the oasis in the venture desert.
Well, it's kind of propping up the VC market.
Yeah, 2022 was bad. 2023 was awful, and 2024 was even worse than 2023 all the way up to the election.
Yeah.
Even going from second quarter 2024 to third quarter 2024, venture was in a free fall except for AI.
I just find it interesting though that the actual dollars going into AI superseded the non-AI startup dollars. Like that blows my mind that really this venture market is literally supported by AI right now. The majority of deployment is in AI. Here we go. Another episode of the Startup Ignition podcast. I'm Tyler Richards. This is John Richards. We're your hosts, and we're excited to dive in today. It's actually just going to be us two today. We have no guests today, and we thought we could go over a little bit more of strategic principles and market research things. We love having guests and hearing their stories and understanding where they come from, how they started their startup, their whole path in entrepreneurship. But also, I think it's great to kind of dive into and talk about just normal entrepreneurial principles and strategies and discussion between my dad and I. And I think we bring a unique perspective in not only being entrepreneurs ourselves and having operated and built successful companies, but also just being in the venture market, being in the mentoring and advising market. We're just all around startup guys. So we just could probably talk about startups for hours and hours. So we're just going to dive in. I actually did another icebreaker, and actually I had a ton of comments about my mic issues, so hopefully I'm not swallowing my mic here, but I'm going to try to keep my face close to my mic this episode because we don't have a guest and I don't have to go left and right and all over the place here. So hopefully my mic, for those who were commenting and telling me, hey, Tyler, make sure you and John get your mics close to your face so that the audio is good. Because I think those that listen just on audio.
I've been listening to mine. I think mine's pretty good.
Yeah, mine's been pretty crappy. But I think those who listen just to audio, like audio is super important. So, but here we go. We are going to do an icebreaker like always.
Okay.
We're going to keep it short though, because we don't have a ton of time today. And when we get into conversation, time flies by. But we're going to do a startup hot take icebreaker. And here's how it's going to work. You're either going to agree or disagree with these hot takes.
Okay.
And they're meant to be controversial. So we just want to establish, do we agree or disagree? Okay. So I'm going to present a bold startup related hot take, and you just say agree or disagree and then briefly explain why. Okay, here we go. Hot take number 1. The surge in solo founders signifies a healthier startup ecosystem.
Disagree.
Why?
Well, I like to focus on scalable startups versus lifestyle or small businesses. Solo founders don't work in scalable ventures long term. During the search phase, when you're trying to find your business model, you can be a solo founder. But when you step on the accelerator and try to scale a scalable venture, you cannot do it as a solo founder. That's pretty much a cardinal rule in the venture ecosystem, has been for decades. And it's just, there's too much to do, too much complementary skill set needed, and you need a team. You need 2 or 3 or 4 co-founders, in my opinion.
Yeah, I mean, I agree. And we've talked about with the guests on our podcast just recently, Devin, specifically, he said him and his co-founder, Justin, almost disagreed on every aspect of the business for the first few years. And he said that brought so much perspective and different scenarios and different thinking to the table, which actually diversified like the outcomes that if he was just operating solo, it would have been completely different.
And scientifically, all of the research shows diverse founding teams outperform homogenous teams, all other things being equal.
Yeah, there's a report called the Startup Genome Project, and I'm pretty sure every year the Startup Genome Project goes over this. It's a yearly report that does studies and takes a massive poll and survey in the startup ecosystem, and they've found that founding teams outperform solo founders almost every time. But the interesting...
You said founding teams, you mean diverse teams.
Yeah, diverse and multiple founders on founding teams, not founding solo entrepreneurs.
If you take all the top accelerators in the country, one of their number 1 rules on application is no solo No lone wolf founders is what they say. No solo founders.
Well, just for context behind that hot take, though, recent analysis shows that the number of solo founders has more than doubled over the past decade. So we're going back from 2015 to 2025, and now solo founders account for 35% of the entrepreneurial market.
I'll challenge that on this score. I think that during the search phase, when you're searching for a business model, that can happen. So is that being counted? Then also, there could be a front man who's so pervasive that you don't notice the people in the background. Like, for instance, it could be a quasi co-founder. We don't call them a co-founder, but they're a quasi co-founder fulfilling that role.
Yeah. Okay, that's one hot take. Okay, I do have 6 of them.
That's an important hot take, though.
Yeah, it is. But they're all pretty good here, too.
Yeah.
So here we go. Not every startup needs to integrate AI. Forcing it can lead to product misalignment. Oh,
yeah. Actually, I agree with that. Yes. Yeah. And that's going to come up later in today's podcast when you go over what you're going to go over. But 100%, you don't force anything just to hit a trend or to use a buzzword to attract capital or investors. But how much have we seen that?
So this take can be taken both ways. Sure. Integrating AI into their product, but what about integrating AI into their everyday workflows? I actually disagree with that. If we're talking about AI should be implementing AI in their strategies.
But I think this hot take is kind of
product focused.
I think it's just I'm going to say I'm AI to attract capital and make investors more interested because AI has been so hot. And I think we're going to talk about that in a little bit. But the point is that it's very annoying to the investment community to have a entrepreneur pitch that they're an AI company when they're really a faux AI company.
Yeah, just slapping AI on your URL or your name doesn't make you AI. But at the same time, I do think I will take the opposing side of this. I do think every startup should be implementing AI in their product.
That's a given.
Well, I guess in their product as well too, because I feel like there's a lot of ways that any SaaS company or software company, if you are, or even just a services-based company, there's got to be AI, customer service reps or agents or AI workflows that work within your SaaS or even any kind of thing. I do think that they should be embracing AI.
Okay, I'm going to be the old guy here and go back in time and set a precedent and show you a pattern. For instance, at the dawn of the internet era, there was a rush to start organizations and things at universities called e-business centers or e-business as we call it, meaning electronic business, okay? Because, for instance, I was in the Yellow Page industry. Before the internet, how you looked up people and businesses was a book published once a year for each community.
Right.
Okay. The internet changed everything. And so they started making e-business centers and e-business initiatives, they called it, and all sorts of things like that. But it became really silly by about 2002, 2003. Remember, the internet hit about 1996 in the mainstream.
So you're saying from 95 to 2005?
Yeah, that was a big deal. Oh, we're going to make this and that. But then what happened is about 2002-ish, everybody started realizing, wait a minute.
Every business has to
Every business is going to have e-business in it. It's stupid. And that's exactly what AI is going to be.
Yeah, so it's like...
There is not going to be a single business, a person in business, or any initiative that doesn't use AI in their business to deliver products and services.
So you're saying xcompany.ai is not going to be a thing in the next 10 years because it's we're using AI.
Yeah. Ford Motor Company, Caterpillar Bulldozer Company are all going to be AI companies if you describe it the way they're trying to do today, because they are heavily using AI in their businesses.
Yep. Okay. All right. On to the next one.
Yeah.
Working for a pre-product market fit startup is often a misguided career move. Working for a pre-product market fit, a pre-PMF startup, is often a misguided career move.
The word often is changing the meaning there. It can be a misguided career move, but I think it's a great career move. If I had a son like you or anybody that I was mentoring and they were coming out of college, whatever, that's a perfect time to join a pre-seed, pre-product company.
Well, I actually had this yesterday. I had someone come to me for career advice yesterday. And I told him, just come over to my house. And he was like, I need to figure out what I'm doing. I mean, he's younger, but not too young. He's into a career, but he's not satisfied and or there's no growth. And he's like, hey, do you think I should be doing education or content or upskilling or learning new things to get into a career that I'm happy with? I'm like, yes and no, because you can go and learn more skills and upskill and become better at what you're doing. Or honestly, you could start a startup, or you could take the risk of being an entrepreneur and your side hustle, or that time that you'd be educating yourself or learning new things, go and put that towards making revenue, producing a product, making moves to a product market fit, validating a business model, and start your own company. And if it takes off, make that your full-time gig, right? That's what I'm saying.
You're my son, but I meet with a lot of entrepreneurs that are young, and I say, if you were my son, here's what I would tell you. And I say, first of all, when you go work for the man, you are renting your time, the most valuable commodity you have, to another entrepreneur who's going to take your time and make 5-10 times what he's paying you in terms of revenue for himself from leveraging your time. The question is, do you want to cut out the middleman and be an entrepreneur and a founder yourself?
Yeah.
And now, so how should you get into the entrepreneurial game? One of the smartest ways to get in the entrepreneurial game is decide how much risk tolerance you have. Some people have more, some people have less. Wherever your risk tolerance is will determine at what stage of a company you can join. If you have really high risk tolerance, then go
earlier.
Just go be a co-founder.
Do your own. Yeah.
Or, if you can't find an idea to jump on or other co-founders, then get on one where there's 2 or 3 really sharp co-founders, but they're at the earliest stage. For instance, let me tell you the story. This is just a fun story. One guy that I knew answered a question on Quora, and the person loved the answer so much, they invited him out to Silicon Valley, and he thought, who is this? It was 3 guys starting a new company, and he flies out from Utah. Out there, he had to pay for his own flight because these guys said, your answer was so good, we want to talk to you about our startup. He goes out there, goes to a dingy apartment building, knocks on the door where he was told to go, and there's 3 guys with 2 desks and a beanbag, and for the next 6 hours, they talk about a startup, and he wasn't the co-founder. He just joined as employee number 4 or 5.
Well, he ended up joining them.
And he joined that company, and that was Pinterest.
Yeah.
And so from Utah, the guy goes out and he gets over a 1% stock option package to join.
Yeah.
And in Pinterest.
Yeah.
So pretty good career move, would you say?
Yeah. So product market fit companies can pan out a lot of times. Yeah. It is the risk tolerance that you have as a career minded individual or as an entrepreneur. Where do you fit on that spectrum of when you should be joining or not?
So let's say
that is a loaded hot take.
Yeah. So let's take an average person. Let's say a person with average tolerance or risk tolerance. I tell them, go find a company, 2 or 3 sharp co-founders, and you can see they've figured some business model things out. They're ready to develop their product. And go tell them you'll clean their toilets, you join their company, just give you some stock options. And if you've got that risk tolerance, give me a little bit of pay. You just work out the best combination. And what you're aiming for is to join the company right before the hockey stick curve starts going up. That's a perfect time to join.
Yeah.
And a lot of people in this world won't join a company. They want to wait till that company's funded, can pay a market rate salary. They're going to hardly get any stock options when you do that. If you can go a little earlier and get a piece of the rock, get equity, and start getting the entrepreneurial game, you're going to be a lot happier.
And sure, if you take it the whole way, that's a great learning experience, but it's also just about learning too. I remember when I was early on in my career, I joined a startup very early on as the number 1 employee because I wanted to learn from that CEO. He was one of the best fundraisers I had ever met. Mm-hmm. And he was building a very complex product that I thought had a ton of legs and that I think could go the distance. And I remember being around him and taking on a lot of his responsibilities as a CEO. He shirked that work over to me, honestly. But at the same time, I learned a ton there. And then my next thing, I went and started my own company, and I was able to take a lot of the learnings that I took from that experience into my own startup.
Yeah, so I think that gave you the confidence to say, hey, I think I can be the founder.
Yeah, it did. It gave me the confidence to say, man, I'm basically doing a lot of the founding work here that this guy is giving to me and giving me that responsibility. I feel like I can take this, package it up, and do my own thing.
Yeah, one last story. Your brother-in-law, who's a good friend of yours.
Yeah.
Okay. He had a job at a very prominent company here in Utah. He gets the opportunity because we hear of an opening at a company that we were close to, that they had the need for one of their first hires. And he had to take a 50% pay cut, no benefits. And he goes over there, but gets a percentage of equity options. And he was debating whether to do it. And I said to my son-in-law, I will tell you, this is one of the hottest startup teams. I think it's going to be an incredible outcome. And that equity that you're getting in those options will be way more than you could ever earn during that same period. Plus, you'll probably in a couple of years be not only up to your old salary, but more with benefits.
Yeah.
And you're going to be so much better off. And you have seen that all turned out.
Yeah, it all panned out. And I remember that his father was pretty against it. So he came to you for advice. Yeah. Again, this is my brother-in-law, so you are his father-in-law. And you were saying, yes, do it.
His father said, don't leave the secure job. Yeah. And I said, do it. Yeah. Take the risk.
Like Senator Palpatine from Star Wars. Do it. Do it. He's the devil. Okay, so yes, working for a pre-product, pre-PMF startup is often a misguided move. I disagree. So I think it is.
I disagree with that.
It's probably one of the best wealth generating things you can do as an individual.
Yeah, I don't like taking the weak sauce argument. Well, that failure was a good education. That's not what we're saying here. We're just saying that if you learn the entrepreneurial tactics and strategies and you keep at it, great things can happen and you don't have to be some incredible, charismatic entrepreneur. Great things will happen.
Yep. So that was a great icebreaker.
Is that all of them? Okay.
Well,
we had more?
There is more.
Okay. But we want to get into our main topic? Okay.
Yeah, just because I do feel like this is going to be a pretty rich discussion because there's a lot of information we want to go over today. So what we wanted to take to today's episode of the podcast was around some of these market reports that have been released over the last month or so. There's two kind of really great reports we look forward to on honestly a quarterly basis, but also the yearly review are really awesome reports. And one comes from Silicon Valley Bank, SVB. For those who don't or are not aware, Silicon Valley Bank is a very popular startup banking bank, and they do a lot of market research and have access to a lot of market information and data because of all the startups that bank with them. But they just released a report that's called the 2024, what was it called? Oh my gosh, the State of the Markets.
2025.
So it is actually going over 2024 data, but it's forward looking into 2025 from the data of 2024.
Let's pause for 1 second because I feel obligated to do this just because I'm a fan. And I just want to say to our viewers and listeners, I want to shout out to Silicon Valley Bank. We bank our fund with Silicon Valley Bank.
Yes, we do.
And we've stuck with them. Some of you may be aware that a couple years ago, there was a banking crisis. Silicon Valley Bank was the cause of it for some of the risks they took as a bank, and they got some bad press, and deservedly so. And the bank has new owners and was taken over by another bank and all that. But we stuck with them through it. We were a little nervous, but we stuck through them with it. And Silicon Valley Bank, and I banked with them a decade ago with my Accelerator Boom startup as well. And they've always been great. They understand the venture world. Their systems are set up to work with the venture world, both with startup companies and venture funds and everything in between. So this report is fantastic. Silicon Valley Bank is somebody you should take seriously and look at. And I just want to make a shout out to them because they've been great friends in my career. And we think since that crisis that happened.
Now they're probably one of the safest institutions.
I think they're probably super safe from that, but also they haven't missed a step with servicing us.
Yeah. They've been great. Okay. So let's look into this report. Again, it's called the Silicon Valley Bank State of the Markets 2025 report. And it's a deep dive into the innovation economy and where things stand for startups, investors, exits, acquisitions, VC. And so I just wanted to pull up that report because I just find it really interesting. And maybe we can just go through and look at some of the trends and some of the information that we find interesting.
Yeah, I've read it and I have a few things I've pulled out that I think are super important.
So hey, before maybe we pull it up and go through it, I have a few things here too that I thought were notable and you have a few things too. So maybe we just open up a discussion. And if you want me to start or you can start either way.
You go for it.
So one of the biggest things I saw within that report was the funding side of it, which was reporting a lot on AI and how AI has actually taken over VC investments.
Yeah.
That 48% of venture investment in 2024 went to AI powered companies.
Yeah.
And I feel like, and there's a graph here that maybe I'll have Jordan put up here from Silicon Valley's report. And the graph shows that the trajectory of, VC dollars in 2024 mapped to AI investments versus the trajectory of dollars of VC spent in non-AI companies.
Yeah.
And it's drastically different.
Yeah.
And like, it's very much so on the AI side, the trend line is up and to the right.
Yeah, I think Silicon Valley Bank, they use this language. They said that AI is the oasis in the venture desert.
Yes.
And so that's how 24.
Well, it's kind of propping up the VC market right now.
Well, let's kind of describe what's going on here. The macroeconomy, the general cycles of the macroeconomy, from the peak in December 2021 went into a straight free fall all the way through election day 2024, in our opinion. So in other words, it was 2022 was bad, 2023 was awful, and 2024 was even worse than 2023 all the way up to the election.
Yeah.
I mean, even going from second quarter 2024 to third quarter 2024, the venture was in a free fall except for AI.
Yeah.
And that's because people didn't know how to react to the geopolitical, et cetera,
But I just find it interesting though that the actual dollars going into AI superseded the non-startup dollars.
You mean the non-AI dollars?
Yeah. Sorry, not the non-startup, the non-AI startup dollars. Like that blows my mind that really this venture market is literally supported by AI right now. There is only deployment. The majority of deployment is in AI.
But this report is saying that there are signs of us having bottomed out and going up. And we concur with that as Startup Ignition, that literally election day 2024 was probably the bottom of the massive cycle.
Yeah.
Okay. And since then, it's gone up.
I don't know. There's a lot of turbulence right now in the markets and a lot of the economy stuff.
But if you even look this morning, and people are going to know when we film this, but this morning, two great things happened, and that are very interesting with the Russia-Ukraine thing. We'll see how it turns out.
What, the ceasefire?
Yeah, and just that they're
But
having...
I don't think Russia has
Russia hasn't yet. But the point is that whatever you want to say, a lot of things are being fixed. You cannot fix everything that's being fixed without the pain. So we're going to go through some pain, but generally the macro thing it's going to, we get things going. I'm an optimistic believer in that we're headed up into a next cycle, but we'll see. But let's just talk about a question from the AI aspect that I'd like to cover, which is
from the Silicon Valley Bank report.
Yeah. The question would be, how do non-AI companies, and again, every company is going to use AI to be more efficient. Okay.
Yeah.
But how do non-AI companies get attention from the venture ecosystem if they're not a pure, true AI company?
Yeah.
And I think that's important. So,
this reporting is pretty bad. It's kind of bleak for the non-AI startup, right?
But right now, in just the last few weeks, couple months, I'm bullish on that. I think a company, it's basically returning to true values. Like you demonstrate a clear, tangible path to profitability. You run frugal and don't waste capital. You integrate AI wherever it makes sense in your company. But the old factors like strong unit economics, a loyal customer base, defensible market position, all of these things, if you have those kind of things going on and they're trending upward in your company, you're going to get attention. If you know your CAC, your customer acquisition cost, and your lifetime value, and those ratios are good, this is all going to be attractive, and you're going to be able to get attention, and you're going to be able to get capital. The thing is, though, you can't just live on hype that people lived on in the latter part of 2021 to raise capital. That's going to be a long time before that comes back.
And mind you, some of this data is also kind of skewed. So don't get super scared if you're not an AI specific tool or software startup, because some of the biggest deals also this report says that were done in 2024 were AI companies. And that just really affects and pulls those bigger deals into that AI category. And therefore it just unbalances what the actual market is doing, right? So if there's like $100 billion AI deal going on, okay, that's going to overweigh into the favor of AI on the total trend of 2024.
How any company gets attention is they solve customer problems.
Yeah.
So if you have identified a massive problem and you're solving it, you're going to get attention. As long as these other things I previously mentioned are coming to fruition, where you're trending upwards in the progress of a venture.
Mm-hmm.
So, but don't think you need to put some kind of false AI label on your company to get attention. Go do real business and solve customer problems. But obviously you use AI to make better products and services and be more efficient.
Yeah, back to that hot take that we were talking about.
Yeah,
right?
exactly. Yeah. Okay.
Okay. Another point that I found in the report that was pretty interesting was that the actual VC firms, there's a huge concentration of the dollars in the VC market. And I think it said right here, it says the top firms raise 1 in 5 VC dollars. So top 10 firms that are venture capital firms, the LP dollars, or the dollars going into all funds, they've raised 1/5 of all dollars.
This is back to the bifurcation of the venture industry.
Yeah.
There's a fork in the road. One way to do venture is get massive capital and try to grow big and fast.
Yeah.
Okay. And do that. And takes a lot of capital, and that's swinging for grand slams. That's what the top VCs do. And they raise a lot of capital from limited partners, and they deploy it into pedigreed founders with massive capital. And that's one way to go. Obviously, the vast bulk and majority of entrepreneurs don't fall into qualifying categories to get at that capital.
Right.
Okay. But so what do? You and I focus on the other fork in the road.
Yeah.
The other fork in the road is in secondary, tertiary tech markets. Let's say Silicon Valley is the only primary tech market. In secondary and tertiary tech markets like Utah or Austin or Seattle or New York or wherever, okay, Raleigh, Durham, all these different places where there's still strong tech activity or venture activity, you can have a set of founders follow lean startup principles, nail a business model, solve customer problems in a vertical niche, create a great company, not give away the company to massive venture capital.
Yep.
Build a company, get to 10 million revenue, sell for $100 million, and everybody becomes wealthy, and some big company buys them, adds them to their stable of acquisitions, and that outcome is that's what you and I work in, and that's how we work.
It's just two different ways to approach entrepreneurship, startups, and venture capital. And so, yes, we definitely subscribe to the latter.
And so let me say one thing that's very dangerous, and I'll say this to the viewers and listeners. It's very dangerous for you to be in a secondary or tertiary market and you read Y Combinator blogs, or you read about what's happening in Silicon Valley, and you think that's how you...
No knock on YC.
No
but
knock on YC. I love YC. But I'm just saying...
Primary markets are a different market.
Yeah. Let's say I'm sitting in a secondary, tertiary, or even lower market, because you can do a business from anywhere.
Mm-hmm.
And you're reading what's happening in Silicon Valley and think that's your path. That's not necessarily the path you're going to ever be able to take. But in your local market, there's going to be investors that'll fund you and help you build a company following lean startup methodologies. And you're going to arrive at a winning business model, and you're going to start having great things happen. It's going to take years. It's not going to happen in 6 months. And you're going to build a life-changing experience that'll, for the stakeholders, change the lives financially, bringing incredible products and services to market, changing the lives of their customers. And that's what we do. We've done that now you've been doing it for a decade. Mm-hmm. I've done it for 3 decades.
Yep.
And it's fun to be a part of.
Yeah. Another part of that, I don't want to bring a ton of attention to this, but another part of that report was around the impact of accelerators. The report also goes over accelerators and the impact that they have in those secondary and tertiary or even lower, startup ecosystems. So not Silicon Valley, not New York, but like Oklahoma or, it says accelerators have a big impact in those small hubs, whereas the accelerators don't have as much impact on the bigger and primary markets,
Yeah,
right?
yeah,
So
yeah.
it's like it's also because I think they might be subscribed to those different ways of building true real business, right?
Yes.
So I thought that was unique. I also thought a cool thing, speaking of YC, real quick before we move on to another topic in the report, was that the majority of success and the VC dollars raised post accelerator comes from the top 3 accelerators, which we've preached this
Yeah.
for the last 15 years, 10 years, that if you are going to join an accelerator, and for those who are listening or watching and don't maybe know that terminology, an accelerator is a cohort of companies that a firm or that a group takes in every so often to accelerate the building
Usually
of business.
gives them a little bit of capital and a place to work
Yep.
and mentorship.
Yep. And mentorship to accelerate the process of building business. And that's why they're called accelerators,
So a
right?
little history of
Yeah, I was going to say, you have a good perspective on this.
So Y Combinator and Techstars, first 2 major ones, have remained major.
Well, the 3 that are listed here that resulted in the best outcomes are Y Combinator, Plug and Play, and Techstars.
Yes. And so I go back, and so I started one here in Utah called Boom Startup at the, this is 15 plus years ago. And it was patterned after Techstars. Techstars, Brad Fell and David Cohen were super nice to me, gave me their playbook. And I started one here along with others called Boom Startup. And it was always ranked in the top 15 in the country. But even saying all that, after the top 2 or 3, the quality and the outcomes dropped dramatically.
I remember being involved in Boom Startup and constantly losing applicants to YC or to Techstars. It was they were debating between Boom Startup and Techstars, and it's like, we're going to Techstars. It's like, we can't fault you for that.
Yeah, exactly. But the whole point being that it's just the way it is. So as an entrepreneur, our tip to you would be, here's my tip. Contact the latest cohort of any accelerator and talk to the CEOs that were in those cohorts and ask them, would they do it again? That's a great thing to do no matter what you're looking at. But accelerators can be very helpful, but you also got to be careful with them. You got to be careful how much equity they're taking. You got to be careful on anti-dilution clauses and different things like that. So again, love accelerators, but also you got to be very careful with them as an entrepreneur. It's turning out a lot of times now that an entrepreneur turning down a lower tier accelerator would probably be the smarter move if they can't get into a top accelerator.
Right. And the only reason I brought that up is because you brought up those secondary markets or those kind of non-primary markets. And I the report actually went over that with the help of in regards to accelerators.
I'd like to steer on it before we leave to the next one you want to steer on. There's one so related to it, and I wanted to quote Silicon Valley Bank's report saying that efficiency is the new growth. In other words, the trend is in this report saying, and I completely agree with it, it used to be growth at any cost. Like, let's get massive capital, growth, and force true scaling by forcing growth.
Right.
Okay. But now it's no, and this is very consistent with lean startup. Now it's much more popular and acceptable to say, I'm going to be an efficient startup who's going to organically have growth happen and scaling happen because I'm building great products and services that customers want.
Right. And the report goes over that the bar is actually higher now. And a lot of this report from Silicon Valley Bank honestly goes with a little bit more mature funding rounds. There's not a lot of pre-seed data here. There's not a lot of angel investing data here, if any at all. Yeah. And so a lot of this is around like more mature venture funds funding Series A.
So let's ask a question regarding what we just said. I like a question like this would be, what are the signals or symptoms that a startup should look for to know when it's the time to press on the accelerator? And I want to answer that if I can, because that's a very important question for our viewers and listeners. So when do we go from being this frugal, efficient startup and saying, now we're going to take some risk and we're going to press on the accelerator and pour on some gas? That's a huge question. And it's actually when you start knowing certain key performance indicators, such as your LTV to CAC ratio, your lifetime value to your customer acquisition cost. knowing that's very important to know when you press on the accelerator, because you
Right.
need to know for every dollar I invest in acquiring customers, how much am I going to reap back out?
Right.
And that takes a little bit of experience. For instance, you're going to just know some signals of that where you've got a growing pipeline, like you've got people that want your product and your pipeline is starting to grow. Your ability to attract and interact and transact with customers is going up into the upper right on a chart.
Yeah.
These are the signals you're looking for. This is so key. You do not force scaling and growth by spending money and thinking that that is true growth. Actually, you want to have growth and scaling occur because you have a growing pipeline of people that are demanding and wanting your products and services.
Yeah.
Does that make sense?
Yeah, no, this brings up also another relatable strategy, which is the WOM Prom score that we know, the article that was written by David Benetti.
Yeah.
And he goes over when should capital be raised or when should you step on that gas? It's when your word of mouth marketing, the WOM, or
Promotional marketing.
Versus the word of mouth marketing in ratio or relation to your promotional marketing is at least 50%.
40 is the number. Yeah.
I think 40%, but 50% is probably even a better goal to have is where, and what that means is your promotional marketing or the stuff you're paying for is, your advertising money, and then the channel coming in, the word of mouth marketing, that all customers or sales or all activity coming in is 50-50 or 40-60.
And here's the academics and math behind that. If you are, for instance, having your customers 95% coming from buying them through promotional marketing, and only 5% are coming from word of mouth, which is customers telling other customers or target customers that this is great. If you're 95-5 on that ratio, you are only, by spending more money and step on the accelerator, you're going to make a crappy growth curve happen faster. You have not got the hockey stick growth curve. And you're going to need bottomless pits of money.
Yeah.
What you need to do is continue refining your business model and your product to where you get to around 40% coming from word of mouth, and consistently that, and it's about 60%. So that means that you're getting a lot of new customers for free from those that you had to pay to acquire.
Right.
And the ratio of 60-40, according to this math, is really ideal so that you can then know when it's time to press on accelerator. But wherever works for your niche or your company, the idea is this: if you're buying all your customers through promotional marketing and your product is not getting word of mouth acquisition, you've got a problem you need to fix.
Right. Yeah. So
Yeah.
important to know, do not step on the gas when you have that 90 or 95% promotional marketing. You're just literally spending, and it's going to be expensive. So, okay, love all of those tips.
Yeah.
One more thing, and because again, this Silicon Valley Bank report is so rich in data and it's cool. But again, back to my point, it's really focused around the Series A round and later rounds. It's not really seed or even pre-seed, which is what we are in every day. And that's what our venture fund focuses on, is the pre-seed venture fund. But it says that the bar, in relation to what you're saying, the bar is getting higher for these Series A funding rounds, which means like the median Series A company now has 2.5 million in annual revenue, 75% higher than that of 2021. So, and we can just see that because of the shift in the VC dollars, right? And the shift in the, economy.
Let's share with the audience what we see, though. So what's funny is there is a lot of Series A type fundings that do happen. And I sometimes wonder what these investors are doing for companies nowhere near those metrics.
Yeah, nowhere. But they're saying that is the median, though. For 2024.
Yeah, but what we see is when you raise too much money at too high of a valuation and you have to grow into that valuation, that's very dangerous for an entrepreneur. You can ruin your reputation as an underperforming entrepreneur. If you have to grow into your valuation, you are constantly battling and fighting against a lot of different things. And we've seen that. How many companies have we seen in the last 18 months, Tyler, that we passed on?
Yeah.
They got a huge round at a high valuation, and 9 months after getting their money, they completely pivot to a new business model.
Yeah.
I mean, that's is that where you want to be as an entrepreneur? If that's where you want to be, all you're going to do is have squandered a lot of capital and burned a lot of people.
Right.
I don't want to be a part of that.
Speaking of valuations, there's more data in this report about valuations. Jordan, throw this up on the screen too. It's valuation growth has slowed, right? Duh, right? Of course, right? It's now taking the typical Series A company more than 2 years to increase its valuation as much as companies in 2021 did in a single year. So valuation growth has also slowed down. And all this goes back to VCs had been tight, and they are like, we need to see more traditional growth metrics and real traction before we go and slap a high valuation or throw a ton of money into something.
Yeah.
Right?
And it's healthy, right?
Yeah.
I mean, being the OG, as some of you call me, or the old guy, which I know that means something else, but I'll say old guy, and not original gangster. But these are principles that are music to my ears.
Yeah. So, and just saying the data, it's all in the data too. So it's not just our beliefs or what we build, or what we think is right, true business building. It's literally the trend is moving this way because the pendulum swung so far the other way in 2020, 2021. But we don't need to beat a dead horse. We've said this 100 times.
Yeah.
So, but anything else that you found interesting from the Silicon Valley Bank analysis?
There's a number of things.
One more thing. Let's do one more thing on it.
Only one more thing. Okay, hold on, man. I got to choose because there's so much good in there.
Okay, we can do 2 more.
Yeah.
I did want to get to the PitchBook report though. We also wanted
let's do this then. Let me do these 2 things then. Exit opportunities are on the horizon. That's what this report said. Okay, I want to comment on that.
What it did say was that in 2024, there was only 7 IPOs.
Yeah.
They're predicting that there's going to be 10 or more this year.
Yeah.
So an upward trend. I didn't really catch, what did it say specifically about exits though, not just IPOs?
Said that they're seeing them on the horizon. And so what I wanted to explain, and they focused on IPOs, I want to explain to the startup entrepreneur out there, the pre-seed and seed companies, why are IPOs so important to you and to the venture ecosystem? This is really important to understand. So the question is, why would IPOs even matter to me if I were, pre-seed, seed, or even Series A? By Series A, you start to understand why that is important. But the bottom line is this: a healthy IPO market thawing out and becoming healthy creates liquidity and validates valuations across the entire venture ecosystem.
Right. It's a trickle effect.
When IPOs are happening and the later stage private equity and VCs are getting liquidity, it trickles back into the ecosystem to the earlier stage ventures, and it's saying, okay, now all of a sudden we can invest more in earlier stage because there's now a pathway to exit and liquidity. This is super important. What happened for the 2.5 years from early 2022 till late 2024 is that there were no IPOs, relatively speaking.
Yeah.
So that created a dam right here. So this dam that's created, and all these later stage B, C, and D, and E companies are piling up at the dam.
Yeah.
It's a dam, and they're piling up here. And then they're running out of capital, and they're not yet profitable because fast-growing SaaS and other type companies consume cash. They're very profitable, but they're constantly growing. And all of a sudden, things started slowing down. And then that just created a logjam all the way down. The least affected were the pre-seed companies, which you and I play in. Mm-hmm. Pre-seed was not that affected because it's not as damaged by that IPO because it's so far away.
Further away.
But it still gets impacted, but it's not as damaged. And so I just want the listeners and viewers here to understand that a healthy IPO market is very important to you 2 founders sitting in your garage starting a startup.
Right.
Okay. Because that is telling the venture ecosystem how much they can invest in you and at what valuation.
Right.
Okay.
On page 8 of the report, Jordan, throw it up there so the viewers can see it. We can see that actually in 2024, that 7 that were IPO'd actually was a miss by a lot. It was 15 were predicted and only 7 happened. Yeah. So this year they're predicting 10, which I think they've adjusted because they're like, oh man, we still don't know if these companies are actually going to go through with these IPOs. But again, every IPO that happens just is such good news for your average entrepreneur.
But I just want to put a footnote to this entire discussion though. A startup or pre-seed venture, now is a great time because Everything works in cycles. And right now, you can follow lean startup principles, find a great business model, start doing all these things we've talked about, building value, and poise yourself ready for the coming boom. That's how we view things. Yeah.
And one more thing. Do you have anything more from this report, or do you want to move on?
I'll just say the one last thing that's consistent, because we're such big believers in lean startup, and they said adaptability is your superpower. So, being adaptable as an entrepreneur is a superpower in this environment.
Yeah.
And lean startup is completely the embodiment of adaptability.
Yeah.
So lean startup is very important to follow so you can have that superpower. That's what I'm saying.
And now also, John Pastana, who was a guest on our earlier episodes of the podcast, go check it out if you haven't watched it. He's a great guy. But
I thought it was a great episode.
Great episode. Thank you, JP, for coming on. Founder of Omniture, sold to Adobe for $1.8 billion. One of the things he always says is, when I'm hearing him lecture or speak or address entrepreneurs, he always says, part of the game of entrepreneurship is just lasting, staying in the game, staying alive, don't die.
I say that all the time. I think 50% of success is staying in the game.
So adaptability, right? Weathering these markets, weathering this current environment, weathering this ecosystem, and wherever it's going up, down, left, right, you have to adapt and pivot and change and find the true business, right? So
the iterative process of lean startup, building an MVP, experimenting and refining is completely consistent with having this, as Silicon Valley Bank calls it, this superpower.
Right. Okay. Let's move on. So another report that came through at the turn of the year, this Silicon Valley report, the state of the markets for 2025, came out about a month ago. And we just found it so interesting. But another one that came through was actually from PitchBook, and PitchBook also had another report.
A shout out to PitchBook. PitchBook also has great
data,
content. Great content.
Yep, they do. And the PitchBook report is the 2024 annual U.S. VC valuations report. So it is historical looking at all the data from 2024. And again, for those who don't know PitchBook, they are a resource in the VC industry and startup ecosystem where they're compiling a lot of funding happenings and data and information.
Yeah, for example, if you're a startup company, they might contact you to get your updates. And if you're a venture capital firm, you'll contact you to get updates. And so they try to keep tracking the venture ecosystem in its entirety.
And they are an aggregator of all that data, and I think it is paywalled, but some of it's open to the public. But a lot of the actual data is behind a subscription, but well worth it, especially if you just want to keep pulse on the VC market and what's going on and the fundings that are happening, especially in your local area or your industry, your vertical.
Right.
It's really cool data. But they came out with this report. So it was a 2024 report of the US VC report. And a few things that I want to talk about that. It's also confirmed in this report that the AI boom still exists, right? They are aligned with SVB, saying that AI accounted for 46.4% of total deal value in 2024. Mm-hmm. So that was almost the exact same numbers from Silicon Valley Bank's report. And then they also said that the early and late stage trends the valuations are slowing down. It's harder to get those valuations. They remain relatively stable, but they're seeing less companies progress stage to stage to stage.
Can I comment on that? I just want to say to, again, the viewers and listeners, this is super important to understand the cycles of business and the cycles of the macroeconomy, and also understanding the public stock market. People are nervous about it right now. You got to remember, it's at all-time massive highs.
Right.
I mean, it is probably super overvalued. That's an argument we can discuss, but there's going to be corrective periods, and it's massively high compared to anything historically. Same for the venture. Like in 2021, the latter half of 2021 I'm very old in this industry, was the zaniest time I've almost ever seen. The dot-com era was also zany, but this was also zany in terms of the valuation you saw in late 2021. So really important to understand that there's going to be corrections and up and down movements, and that's part of business. And part of our skill set as entrepreneurs needs to be taking advantage of the cycles and knowing where things are at. So don't get overly nervous when things go up and down in cyclical movements, because that's part of the game. You just need to know when to start something, when to exit something, when to get into something, and when to get out of something.
Right.
And that's now, so what affects most of us listening on this podcast would be, okay, the venture ecosystem, the public stock market, and the crypto markets are probably the three that you're going to see go up and down.
But which are all affected by the Fed rate.
Yeah, and then it comes back down to what the Federal Reserve of the United States is doing. But again, what we need to understand is over a 10 or 20-year period, which is the horizon you need to have as a person endeavoring to be in entrepreneurship or in investing, the trend is going to be up. Peter Lynch, and I'm quoting him, some of you won't know who he is, but he's one of the most famous Fidelity mutual fund managers of all time, one of the most successful mutual fund managers. He said, I don't know where the markets are going to be a year from now, but I know there has never been a 20-year period in the United States history where you did not make money from investing in businesses in the stock market.
Right.
Okay. So, and he says, I could even shorten that to 10 years. I'm pretty certain 10 years from now, things are going to be higher and better on any investment I make.
Yeah.
Okay. But next year, I could be down a little. Okay. That's the horizon and the outlook you need to have as an entrepreneur. By the way, a startup entrepreneur, you're not in it for a quick flip in 6 months.
Yeah.
Who cares what
It's
happens
a
in the
long
next 6,
game.
12 months? If you start a company today, you don't care what's happening in the macroeconomy in the next year. You're going to be frugal, and you're going to go find an incredible problem and solve it. And you're going to be frugal and lean, and you're going to start getting customers because you're going to have identified a hair on fire use case, and you're going to solve that problem, and you're going to start building a company, and the cycle's going to catch up to you. And if you time it just right, like all the companies we invested in 2010 and 2012 that were in the depths of a recession, those companies by the end of the decade were flourishing better than ever, and we made a lot of money.
So what you're saying is, if I'm understanding you right, is that the macroeconomy is important, but it's not important on like a daily, yearly, monthly kind of viewpoint.
Let's just take the stock market.
But
Trump talking about tariffs, the Ukraine-Russia war, ceasefire, no ceasefire, tariffs on or tariffs off, fighting with Canada, Mexico, whatever is going on here is going to have daily fluctuations.
But it's not going to be, it's not going to impact the entrepreneur's venture.
But to you, the startup entrepreneur, that doesn't matter. What matters is that you go identify a problem and a customer who has that problem, and it's big enough to start a company on, and you go make a great product, and you start getting customers, and you know your metrics, and you can go to investors and say, I've now figured something out. I need growth capital. You get the growth capital, and you make a great company, and then you get bought, and your life is changed forever.
But it does matter. It doesn't matter on a daily, weekly, monthly, maybe even yearly view, but it does matter the entry point and the exit point.
Yes.
Though.
For instance,
that is completely
the worst
crucial.
time in the last decade to start a business would have been the latter half of 2021, because you would have raised easy money, which we saw many companies do.
Mm-hmm.
Easy money at high valuations with no business model. And then all of a sudden, May of 2022 hits, and the rug's pulled out from under you, and you just burn all your capital, and you shut down and have a total failure because you never got to a winning business model. And that's bad timing. Okay. Great timing is in 2011, I start a company. I go through the lean startup process, pivot to a winning business model, take 5 years to get revenue up into the millions. And then all of a sudden I'm starting to cross the 10 million in revenue mark by 2018, 2019. And then all of a sudden 2020 and 2021 happen, and I sell my company for a boatload of money. We saw that happen a lot too.
Right.
Right. And so
enter low, exit high. You can look at any of these reports that we're talking about today and discussing on this podcast, the Silicon Valley Bank, the PitchBook report, all of them are peaked in 2021.
Yeah. So
every single graph, every single data point is peaked in 2021. So that's obviously sell high.
Yeah.
You don't want to be entering into a peaked out market.
So just be aware of the cycles. To all our viewers and listeners out there, we'll just tell you, we follow the cycles and know the time. This is a great time to start a company right now, a great time. And you just don't overraise, don't give away too much of your company too early, figure things out and get a great business model, start getting customers. It's not rocket science. It's not that hard. You can go do it. We've seen all types of people do it and make incredible things happen.
I mean, but here's the thing though. I understand your logic of, hey, for the early stage entrepreneur and, maybe those that are in the idea or model or traction phase of a startup, we have this business validation roadmap, startup validation roadmap that you've created. Yeah. And maybe we'll have Jordan slap that up on the screen real quick here. So those that are in the buckets of the earlier stages of a startup, sure, that I understand the logic of, hey, be heads down. Don't worry about what the macroeconomy is doing. Don't worry about all this tariff and news and federal rates and crypto markets or stock markets. The fluctuations are the fluctuations.
Because you can be adaptable to whatever happens.
Yeah. But now the opposing side of that is if you are, again, on that validation.
A fully baked company,
or even just in the build or scaling mode.
The concrete starting to harden.
You do need to pay attention to those movements because you have to know, okay, is this a good exit time or am I in a trough?
Well, let's look at
because you want to extract as much value as you can from what you're building.
Let's tell them about the Utah ecosystem. We're in Utah. Utah has created more unicorns per capita than anywhere in the last decade. That's my belief, my understanding of the data. So what happened?
That is true.
Yeah. So
per capita.
Yeah. So
per capita though, that's important because obviously New York and Silicon Valley have a lot of unicorns.
But let's look at what happened to companies. Companies that started in the 2010 to 2014 era, let's say that, which was coming out of the trough. Okay. Then there were companies that reached their pinnacle in the 2018 to 2021 range and got an exit and fabulous wealth creation for all stakeholders. And also just they got bought by a company that was bigger and could even take that to the next level. But there's also companies that started in that time frame, maybe a little later, could be 2015, 2016, and they did really well and things were looking good in 2020 and 2021, but they didn't get an exit in 2021. They've had some tough years.
Yeah.
The last 2.5 years are tough because people started reducing their spending. There were no exits. It was harder to raise money. And if they were not yet profitable, they had to really clean their house and fix things. It's been a tough road and that's tough and that happened. The question is, if they survive till this next cycle up, they're going to be fine. But many didn't survive it. And that's just the way it goes. But that's why if you were to hear our Startup Ignition Ventures pitch and see it, it's completely centralized in this concept of cycles. All asset classes are subject to the cycles created by the Federal Reserve of the United States. All asset classes, including venture. So venture needs to be aware of it. And so you're saying a CEO of a more fully baked company needs to be aware of these things even more than the first year startup.
Right. Yes. Let's say they're more mature company. They do need to be aware.
Yeah.
One more thing from the PitchBook, the annual U.S. valuations, VC valuations report that they produce of the 2024 data, it was showing that 2024 had the greatest percentages of down or flat rounds in over a decade.
Yeah.
Right. Which seems very duh, but I think that's really important because even prior to the COVID boom or the frothy times that all of the money being pumped into the system provided to entrepreneurs in the venture market, even going as far back into 2014, this was the year that had the most down or flat rounds than any
It's like
other
I
year.
said, 2022 was bad, 2023 was awful, 2024 was even worse.
Yeah, Jordan, just slap up this graph as well. This is on the PitchBook report. I think it's on page 7. And you can see that, 2024, it was like, we're not just guessing here. We're not just saying this. It was one of the worst years that
we're investors in other funds and we've gone to their annual meetings. We hold our own annual meeting for our fund, but we've seen these slides all over the place, right?
Yeah.
And it's just that 2024 and flat rounds, it was tough. But you know what? Getting a flat round, meaning the same valuation as the previous round, was a win for these companies.
Yeah, because there were more down rounds too.
Because Tyler, since 2022, how sad has it been that you and I have had to sit and listen to and be around the companies that raised millions of dollars, cannot raise any more, and their companies are just going straight down the tubes.
Right.
And they've come to us, a small pre-seed fund, wanting us to save them. And that's not what we do. And we have, and our advice to them is stark and not always great.
Well,
You're in a tough situation.
You need to correct the ship the right way.
Yeah. But the worst things we saw, and so this is a lesson for life. Don't ever do this. When you face these kind of situations, do not keep your burn rate the same as it was in the end of 2021. And because we saw companies that had massive burn rates in December of 2021, and they had enough runway at that burn rate to last for about 18 months. But what would have happened if they had cut their burn rate in half or even by 75% decrease and give themselves 3 or 4 years of runway to survive this 2.5, 3 years that we knew we were going into, and they would have been just fine. But we saw so many companies continue a massively high burn rate and run out of money in mid 2023 and go under. And that did not need to happen. So entrepreneurs need to go get mentors, need to get help from old guys or others that have been around the block before and can tell you how to manage these situations. I've lived through about 4 major cycles in my career, maybe 5. This is your first, you haven't, this is your first down cycle.
Yeah.
You started in a trough.
Yeah. I started in the last down cycle.
Up to a peak.
08.
And then you and others like you were the first 6 months in 2022 was a shock.
Yeah.
And to all of you, it was like literally deer in headlights.
To my generation.
Yeah. Deer in headlights.
Yeah.
And for me, I'm going, no, this is opportunity time.
Yeah.
Okay.
It's opportunistic.
Yeah.
So, okay.
Yeah.
Both these reports, I just thought we could go over, pull out the things that we thought were interesting. We highly recommend reading them as an entrepreneur. You need to understand where we're at, what's going on.
I think you can freely subscribe to Silicon Valley Bank and PitchBook's reports like this.
Oh, 100%.
Yeah.
I think they might take your email address, so you are selling your data for the reports, but still, hey, they're great reports. They're super rich.
Yeah.
Okay. I want to close the episode by taking a few questions that we got asked from our last episode.
Okay, go.
There were some really cool comments on YouTube, on our community.
Oh, I haven't even read those yet.
Yeah.
Okay.
And people that were asking, hey, what about this? And so let's end with one of these questions, then we'll wrap things up because I think we are getting close on time. But to wrap up the report section of the podcast, go read those, go look at them, go download them, and go dissect them. Okay, moving to our audience, just one audience Q&A because I think we'll only have time for one. So here's one of them, and I'm going to pick the best one, or what one I think would be the most relevant for our listeners. This was from our community. Someone posted this within our Startup Ignition Academy community. What sectors outside of AI still have strong VC interest? And I thought that was very relevant to the reports and the state of VC funding, because again, more dollars go into AI funding than they do anything else. So what other sectors are still pulling your interest?
Okay, our interest. Okay, so
okay,
all interests. We don't have any data to go on. I haven't seen any reports of that.
Yeah,
generally. So we can just say what we're interested in.
Well, we just went over the reports that it's heavily weighted on AI.
Yeah.
Okay, but excluding that heavily weighted AI skewing of data.
Okay, so let's set this up a little. Let's go back to what we said a few minutes ago. The fork in the road. We ascribe to not get massive capital, grow fast and big, and shoot for the moon on completely Silicon Valley way. We're a secondary, tertiary market type of investor saying, let's get a great team together, identify an incredible opportunity, and go build a great company.
Which also is less dilution, more equity for those at the table.
We often say this, you can create a $1 billion+ company and end up with such a low percentage, you make, $25 million. Or you can do it the way we ascribe to, build $100 million companies, ended up with $25 million for yourself as a founder, right? Okay. So anyway, based on all that and how we look at the world and where we're going, we still, and I'll answer first and you can answer what you think, but we're still very bullish on companies that have really strong founder market fit. So we love it when the founder really passionately, to a healthy obsessive point, knows their vertical market they want to be in and attack. That's a really key one. Okay. Then they also, on top of that, have identified the biggest problem in that maybe hyper vertical. So not just a small problem, but the top 1 or 2 or 3 problems that their target client customer base in that vertical market is wanting fixed.
So, but I know that we are SaaS investors. Yeah. And the question was,
whether that's solved by a SaaS product or not, it's still interesting. You've got founder market fit, and there's some problem. Like we are looking right now, let's not name the company yet, but we're looking at one and just getting experience with one that's a completely tangible product, very engineering related. And he has identified a problem and an opportunity and can create a product to replace existing solutions that's very high margin. It's not software.
Nope.
Okay. It's just a tangible physical product. That's interesting to us. And we look at founder market fit. Has he identified a big market and a problem? And is there good margins in his because the tangible product, we got to look at unit economics.
So I understand.
So does that make sense?
Yes, but I understand the general underlying principles, like what makes a good investment or an attractive investment or attractive venture. Sure, big market, founder market fit. But what sectors specifically would you list?
Well, people publish this all the time. You can go to Entrepreneur Magazine and go to others and look at the hottest new verticals to look at and what it's coming.
Right. So outside of AI, you're still saying SaaS is obviously there.
Well, I could say this: SaaS software or even a tangible product that has the elements we're looking for we can't say, because if somebody comes to us in a we don't even know anything about the vertical market, but they got founder market fit and they teach us that market and they show us incredible solution and they show us that incredible solution and it's got great margins and they're getting traction
and it's validated.
All of that is going to be exciting to us. So we can't say, so it goes like this.
So your answer is sector agnostic.
Sector, industry, company, right? So economy, sector, industry, company is how you pedigree the economy. Okay. So saying what industry or sector is interesting to us, there are ones more interesting. We don't really jump on bandwagons as much because what's really key is you can create incredible value in an old industry. Like for instance, let's take SaaS. There are still massive numbers of vertical places where paper and pencil or old-fashioned software or Excel or Google Sheets is doing the workflows. So show me a SaaS that replaces those workflows and I'm going to get excited.
Right. Okay. So I do think the answer to that question is don't focus on the sector, focus on like building a really good solution to a really good problem with a very big market.
Be a problem hunter and find a problem, devise a solution. The more founder market fit and the bigger the market is and the higher margins, the more exciting it's going to be.
Because we've seen
I don't think we should go chase what's the latest hottest trend.
I'm not a trend chaser. I don't like that. I don't prescribe to the trend chasing, but I do think that we can get excited about almost any sector if those attributes exist. That's like the answer.
We tend to not want to be involved in physical, tangible products because of the necessity of a company spending 25-30% of its time and resources on inventory management. Okay,
inventory.
But if you showed me if you showed me an incredible, tangible product that had software-like margins and was hair on fire use case for their customer, I'm still interested.
That's still an exciting sector. Okay. All right. Thank you so much.
Hopefully you like listening to us.
Hopefully that wasn't too much for you guys and a fire hose of information.
We're trying to deliver meat, not just fluff stuff.
We really want to bring and break down the industry, really give good strategies and principles. So I hope that's being communicated. Hopefully we're not just in our own la la land thinking that we're doing something cool when we're not. So let us know.
Subscribe.
Comment. Help us out. Tell us
how to be better.
Be a part of the podcast and help us understand where we should take this thing, what we should talk about, and what we should do, right? I think we're very open to that.
Suggestions for guests? We got a lot of guests coming. We're going to have some great ones. If you haven't seen an episode so far, we got A quality guests.
And we almost had to make ourselves not bring a guest on today because it was like,
we've done so many guests recently.
We do want to go over market data and strategies and principles and not bring into other entrepreneurs' stories into it. It's great to hear from them, but we also feel like we can provide some value to you guys. So hopefully you're seeing that.
Let's sign off.
Yeah. So we're going to close up this episode. Thank you for joining us. Again, follow us, listen to us, share this thing, and we love you guys. Thanks so much for listening and or watching, and we are signing off. Startup Ignition Podcast. Thank you.